Presentation does not constitute a recommendation, an offer to sell, or a solicitation of an offer to purchase any securities and may not be relied upon to evaluate the merits of investing in the securities described herein. An offer to invest will only be made by means of a confidential private placement memorandum, PPM, to be furnished to prospective qualified investors, which will contain a description of the material terms, including without limitation risk factors, conflicts interests, fees and expenses, and tax aspects relating to the fund. Prospective investors should review the PPM before deciding to invest and should only rely on the PPM to decide whether to invest.
Hi folks, this is Mike Zlatnik, Big Mike, and today's conversation is going to be all about stock market volatility is up. Where do you find safety and predictability in this environment? So let us just reflect on the last couple of days of stock market and bond market activities. First of all, stock market volatility is up through the roof. VIX index, which reflects the volatility, is up massively. The investors are nervous. Why? Speculation that the economy is already in a recession, or we're going into recession inevitably, and it may be a serious recession. Everyone knows anecdotally that the consumer, especially the bottom, let's call it 50% of the consumers, are paycheck to paycheck. They're struggling with overloads of debt. Inflation are destroying their ability to buy, and the overall incomes are growing at a much slower pace. Unemployment data is pointing out to substantial jumps in unemployment. So real recession is either here or right around the corner. And the data comes through the rear view mirror look. In other words, by the time they announce, hey, we're in recession, it's already been a recession for many people for often multiple months. So stock market is sort of waking up and has been very concerned. Interestingly enough, some fundamental investors like Warren Buffett have been net seller for a couple of years now. So there's some fundamental forces out there that pointing out that the stock market is significantly overvalued and there are better places to be, or at least consideration to diversify, rebalance portfolio outside of the stock market. Now, in the short run, where has all the money flown? It has gone into the bond market. Large amount of dollars have flown to buy bonds essentially flight to safety, looking for immediate yield. But the bigger play in that trade is to see the appreciation of the bonds as interest rates fall. So that is the general expectation that the Fed will act. So a couple of words about the Fed. Fed appears to be sound asleep at the wheel, although the job is complicated. They've always had the dual mandate, and we've talked about that in the past. They're shifting from the inflation fight mandate to the let's deal with the economy, let's deal with increasing unemployment. And they've made it very clear that the first rate cut is very likely in September. Some folks are speculating for an emergency rate cut. Unless something breaks very hard, it's unlikely in the election year that the Fed will act ahead of the next scheduled meeting. So that's my couple of thoughts, although situations, of course, could change rapidly if some seriously falls apart. So first cut in September, will it be 50 basis points? Some folks are speculating. My personal opinion, and I don't have a crystal ball. Well, I used to say I used to have it. It broke. Can find now for sale. I highly doubt it. Quarter is probably the most likely outcome, and then they'll move more aggressively after the election. So that's kind of the outlook. But where the opportunities ahead, right? Buying bonds, is that the right opportunity? Well, the yields have come down substantially in the last few days as a result of capital shifting out of the stock market into the bond market. And they're looking for safety and looking to get appreciation as bond yields fall. So, but that trade has limited opportunity because of the fact that the bond yields moving down fast, and you can only take advantage of the trade for a while. After that, you have to sit and wait, and your yields, you're earning the returns on your investments are fairly low. Are there alternatives to this? Is there something else that folks can do? Of course there are. There are plenty of opportunities. And now we're going to talk a little bit about lending funds or income-focused real estate funds that typically loan money where the banks have never lended or have reduced their lending. So bank lending has fallen off the cliff. We've seen bank lending fall roughly 50% year over year as a result of credit tightening. So a lot of loans can't get funded just because the banks are just not doing this. So the investors' only option is go to private capital, alternative lenders, hard money lenders. And that space is a phenomenal opportunity to participate in today. There are funds that invest in hard money loans, originate hard money loans, are focused on these type of investments. They do primary debt loans, first lien loans on fix and flip projects and other ground up construction, etc. And there is also secondary gap funders, mezzanine debt, etc. Both of these strategies make a lot of sense. Properly underwritten opportunities can be very, very lucrative to investors on a risk-adjusted basis. We certainly run a fund like this. We run Tempo Income Fund, and we are biased in this conversation. But if you're interested in the fund, of course, reach out, request PPM to accredit investors only, consult with your attorney and CPA professional before making investment decisions. But we are seeing great opportunities for our lending funds today. Again, we have Tempo Income Fund that focuses typically on primary debt, and it mixes up a few other strategies. And Tempo Advantage Fund is our mezz debt lending fund, focuses on typically mezz financing in the form of rescue and recovery, as well as gap funding on the projects that are short a little bit of capital. So we come into these very interesting niche where because of this bank pullout of the lending business, as well as stock market volatility, the lending funds today represent one of the best risk-adjusted investment opportunities. Now, is opportunity going to be multi-year, long-term? Well, we don't know that. But what we do know is in the short term, the lending opportunities are phenomenal. We're able to charge higher yields. We're able to underwrite more conservatively, lower to value LTV ratios with great borrowers. So that's what we see opportunities ahead for the next 12 plus months. You could look at it as a way to deploy the cash for short term. You can also look at it as a way to deploy the cash for the next couple of years. And to get double-digit yields in stock market has always been super hard. I'm not saying it's impossible, but it's very hard. Most of the returns in the stock market came in the form of appreciation. And today, again, the bond trade is also relying on the expectation of yields falling and the appreciation in the price of these bonds. Now, can you get the same type of returns even better without the same level of volatility or uncertainty? Of course you can. That's the point. That's the lending funds as a way to participate in the sector. Now, soon enough, commercial real estate equity plays are going to look incredibly attractive as interest rates fall. It's a massive tailwind for the commercial equity, commercial real estate equity, just to be clear. And we're working with great partners and sponsors, and they're beginning to see opportunities ahead where they can buy from distressed sellers and now get substantially better cost of money as interest rates begin to fall. Or refi options become available. As interest rates fall, projects that have been dealing with or have not been able to refinance because of a higher rates, now they can refinance as their debt service coverage ratio improves. So lower interest rates is a significant tailwind for commercial real estate equity component, and being a lender in that space is a phenomenal place to be. So again, just outlining some alternative opportunities to the stock market, and then the bond trade, again, U.S. government bonds with other bonds that trade in public markets. There are better opportunities in alternative private markets, in a matter of speaking. So, folks, appreciate the time for listening. Please reach out, speak with us if you have any follow-up questions. We appreciate your time and attention, and have a wonderful day. Thank you.